We are talking to Vikas Rathee, the Group CFO of Prime Focus. Hi Vikas, thanks so much for joining in to detail your numbers. Vikas, we are aware, as per the notes that were given, that in this quarter, it marked the completion of double negative as well as PFW. So on the back of that, we can't really compare the numbers. But going ahead, can we look at revenues? Now, in the last quarter, you gave us revenues of around 350 crores. So will that be the revenue picture we can look at on a quarter-on-quarter basis?
Yes, thank you again for having me here and good to be speaking with you. I think 350 is the number we should be building upon. Okay. I think one of the things you haven't seen in this is the transaction that is still in the works on the Reliance Mediaworks side. Also, just this quarter, given you have July and August, which is as you can understand, the West, it's a holiday season. The September quarter is kind of slow from our industry perspective anyways. So you should see the subsequent quarters build upon on the revenue, just from a core business perspective, but also, you'll have additions from the Reliance Mediaworks business come on, hopefully by the end of December, if not into the first calendar quarter.
Vikas, hi, afternoon. When we had spoken to you last time, just a few months back, you had given us a margin target of reaching 20% by the end of FY16. In this quarter, your margins have come down to 3%. Would you look to, scale down your assessment of margin growth in the next, maybe this year or FY16?
No, not really. I think, we obviously, this was a horizontal kind of a transaction merger, wherein we've, where the DNEG, which is one of the largest players in the VFX market, kind of merged with us on the creative services side. So obviously, there's significant duplication on personnel costs, which is kind of what you're seeing from the margin perspective. We have taken significant efforts already on the reduction of duplication on the personnel expenses side, also facilities closure. So I think this is as planned. For integration and consolidation-based transactions, you'll always see one-time impacts of restructuring costs that will come through. We are still very confident on 20+% margins for FY16.
All right, Vikas, so if in fact you need to get to that mark, then you'll have to see some reduction on employee costs that you were mentioning. For this quarter itself, employee cost for various reasons was at around 230 crores. Going ahead on a quarter-on-quarter basis, how much can we see that number? And even at other expenditure, that one as well ballooned up to around 100 crores. So with regard to both these two entries, what are the figures that we can look at going ahead?
See, I think, we are a technology-led business and also people-intensive as well, from a visual artist perspective. So I think, our personal costs are going to be in the 40-odd% range, obviously higher this time around. Like I said, there's duplication across our businesses, both on the creative services side. Some of that impact, when you say other costs, fundamentally is some of the restructuring and stuff that's coming through. There's also duplication on facilities, and that also we have kind of cut down during the course of this quarter. So, where we kind of see that is, as people and the duplication cuts down, some of that we've seen, a large part actually, I should say, in this quarter. There'll be some residual effects that you're going to see in the next quarter. But these one-time cost reductions are absolutely necessary to create the marginal synergies that we are looking to anticipate. To give you a sense, given the cost base we have in India, we have perpetually being north of 20%, 20-25% kind of EBITDA margin business. The mergers or the entities we are absorbing in the West typically have, low single digits or just about, high, I would say very low double digits kind of EBITDA margins. So, and it's primarily because of the cost of personnel being in the West versus being back here. Not dissimilar to what you see in IT services companies. So I think the trajectory is to be able to do a lot more work background from India, keeping your sales, marketing, and hire an artist back in the West and get the benefit of scale and cost here. So that's where we come from in terms of how we see the trajectory of going back to above 20% margins by FY16.
You spoke about your deal with Reliance Mediaworks, where you all will be merging the films business, that to accrue hopefully by December quarter, if not, the March quarter of next calendar year. Can you give us what will be the financial impact maybe in the December quarter and also in the March quarter?
That's a very good question. I think, we're very excited about that transaction, especially in terms of what is going to add to our already impressive lineup in India. The Indian media and entertainment market continues to grow very, very rapidly, both on the film side, but even more so on the television side of the business. So I think what you should expect that is not too much of operating cost that's going to come on, because we have a very similar business already in here, but the value proposition and the opportunities we'll provide to the Indian customers
Any numbers?
Significantly enhanced. That's a good question. I think till the time the transaction really closes, I would not want to venture that guess. But to give you a sense, our domestic business on the EBITDA side, had north of 40% EBITDA margins in this current quarter on a standalone perspective. We believe the domestic business, with the combination with Reliance Mediaworks, should deliver EBITDA margins north of 50%.
All right, Vikas, then let's get some more numbers from you. A couple of deals that you've closed. You've said that DAX integration, that's working out well. You've added 3 new customers. Give us a number.
Well, I think these numbers kind of, I think that it's the quality of the customers you add. We've added FX Networks, we added Crown Media, and the others. I think, the exact impact in terms of what you would see is going to be over the next 2 to 3 quarters. It's not going to happen immediately, but it continues to kind of grow. I think these 3 customers together should start adding more than $1 million of revenue when fully up.
Okay, and one final word on your working capital as well as debt. Any change in this quarter? And any change
on the debt side, I think the working capital is starting to get better. I think from our perspective, we're getting more and more of our customers coming in. We're getting better contracts. The addition of double negative has a big impact on that as well. I mean, they've got very low working capital days, given they've been operating in the Western world for almost 20 years. Wherein we on the Prime Focus world side, obviously we're climbing up the ladder. So that always has an impact in terms of your negotiating leverage with customers. In terms of debt, the debt addition you see primarily is on the back of the double negative merger. They bring along around 130, 140 crores worth of debt in pounds, but this is low single digits, sub 5% cost of debt, primarily in the form of equipment leases and some working capital facilities. We have, and during the quarter, paid down a significant amount of high-cost Indian bank debt. So you'll continue to see our debt load, initially moving from higher cost to lower cost, and then through the course of FY16, you should see a reduction on that as well.
All right, Vikas, one final question before we let you run along. The promoters' holding is roughly around 42%, and I'm just looking at the total pledged holding of the promoters. It's more than 50%. Could you give us some more clarity on that? Where exactly does this pledge go?
Yeah, see, every single pledge that the promoter has today is in relation to the bank facilities we have at the company level. So not a single share is pledged for their own benefit, or if there is, I think it's very small. So as part of the banking sector has gone through a fairly stringent time over the last 12-18 months, and I think promoters need to be tied in, and that's where the banks have been. So to give you a sense, we have reduced the pledge significantly over the last 6 months, but I think it'll take another 6 months before it comes down even more.
All right, Vikas, thanks so much for joining in and giving us all those details. All the best for the second half of this year.